Hello, and welcome to the Without the Bank podcast, where you and I are going to talk about all things IBC, the business of banking, utilizing money correctly, and how this will help you create your wealth. Thank you for being here. I appreciate it very, very much. And if you were to leave a review, I would appreciate that as well. I prefer 5 stars, just a little secret, but you know what? I don't believe in getting something I don't deserve. So if it's not 5 stars, that's okay as well. I'll still like ya. Okay, today we're going to talk about policies on kids. This is not something we've talked about a lot, but this is a common question that I am getting as far as, hey, I want to, this is awesome for me, but I want to start something on my kids because currently we're doing a 529 plan, or grandpa and grandma are giving the kids money and putting money into 529 plans, and we want that money to go into life insurance. What does that look like? Well, when we set up a policy for an adult, anybody 18 and over, that policy grows faster because of how it's structured. We are putting more money to cash value in most cases. Okay, not every single policy is exactly the same. Some cases it does not pay to do that, but the majority of the time, if we are business owners, we want access to cash, so the majority of our money is going to cash value. We can structure it that way because you are an adult. Now, if it is a child, we can't structure it that way. I can't put 75% of your money to cash value. I can maybe put 50% there. I can maybe put 60% there. It just depends. In some cases, we can only get 40%. It depends how much money you put in. It depends the age of the child, all that good stuff. We also have a limit on how much death benefit a child can have. Children can typically only have half of what mom and dad have, or up to $1 million. So it's great intentions to say, oh, we're going to put all of this money there so that they have money to pay for college. The upside is that if we put the money there, it's guaranteed, right? It's going to grow every single year. The market's not going to collapse the year they go to college or a year before they go to college, and all of a sudden we don't have any money for college. That's the risk of a 529 plan. Also, if we do a 529 plan, we can only use it for college. We can't use it if we want to start a business. Not every child goes to college. I can tell you, I have 3 of them. One of them loves college. The other 2 are avoiding it at all costs. They are not going to go. One is going to be a business owner. She has already said that. If it is a degree, she is 16 years old. She asks, since she has been a 6th grader, she has asked, do I have to go to college for that? I'm not doing it then. Do I have to go to college for that? I'm not doing it then. Okay. So there's going to be degrees that we're going to be able to get online. Are you going to be able to use 529 plans for those things? These are all legitimate questions. I have friends that have 529 plans for their kids that never went to college. They are furious. Market crashes right before the kids go to college. They are furious. So a lot of people are naturally looking at whole life. It's going to take at least 15 to 20 years to break even on those policies. So if we're going to put $1,000 in every year, in 15 years, we're going to have 15 grand. Okay. Long term, you make a ton of money. So in the insurance world, and I am sure you have heard me say this before because I say it all the time, you either get your cash now or you get it later. When I structure a policy that you can put 75% of your money to cash value up front, that means it's going to grow slower later. If I flip that around on a children's policy and say, oh, we're going to give you less up front, you're going to have more later. Okay? So there's different, it's not that one is better than the other. It's just, when can I access the money, now or later? That's about what it ends up to be. A lot of people say, oh, traditional whole life is a terrible product. If you have an agent telling you that traditional whole life is a terrible product, they don't understand what they're talking about. And I know this firsthand because when I first started in this industry, the person that was training me said, oh, whole life is a terrible product. And that's what I believed until I heard the numbers and I looked at the numbers. Traditional whole life is just really slow and we don't have access to the money now. But if we go and look later, they're very close to the same policy because one's going to be up here, one's going to be down here. So with a kid's policy, you're either going to have that money up front. The more you put in, take you 15 years. You put $1,000 in, you're going to have $15,000. That's going to buy a pretty crappy used car in 15 years. Today it buys a fairly decent used car. In 15 years from now with inflation, it's not looking good. Is it going to send the kids to college? No, it's not. $15,000. College is also increasing at about a rate of 7% per year, and that was before the COVID crap. So I cannot imagine in today's inflationary rate of 7% what we are looking at for college. It's just not going to be enough unless you put $3,000, $4,000, $5,000 a year into that thing. Is it going to help them buy a used car? Is it going to help them maybe pay for a little this or a little of that? Absolutely. Is it going to help teach them the infinite banking concept? Absolutely. Is it going to be a good policy the rest of their life? And when they are 70 and 60, they are going to say, oh my gosh, mom and dad and grandpa and grandma were the smartest people on the planet. Is it going to be this wonderful short-term answer? Nope. If you have a child that's 15, 16, 17 years old, you're like, well, Mary Jo, they don't have anything at 20. No, take some time to capitalize that system. So if you are looking at getting a policy, and here's the other thing. If you want a policy on one child, you have to do a policy on every child. And the company that I work with says, you can only be within $25,000 to $35,000 difference of death benefit per child. The life insurance companies don't care about the premium. They care about the death benefit. So this happens too. Well, I have one child that's a really good saver and they're 16 years old and they have a bunch of money in savings. And then I have another child that might be 15 years old and they're not a good saver. And so, or one works and does a bunch of stuff so that they can make extra money so they have a lot more money to put in. Life insurance company does not care about the premium. They care about the death benefit. So we have to get those very close together. You cannot own a policy if you are under 18 years old. You can pay the premium out of your savings, but mom and dad have to own the policy. Well, what do I do with the policy? When do I turn it over to the kids? That's another question. When you decide the kids are financially responsible to make sure they're not going to cancel that policy, make sure that they're going to continue to pay premiums. You could co-own the policy with that child. So if they didn't pay their premium or they do something crazy, you have to sign off on it. You get notifications on it. I actually have a client who started a policy on his adult child, gave the policy to his adult child, and the adult child canceled the policy. Somebody else told him it was a bad deal. Because why? Dad didn't teach the child what he was necessarily doing. The child never met with me. If we are not going to teach the kids what we're doing, why are we doing it? The whole point of this is to make sure that we're passing something off that the kids understand. It is crazy how many adults I meet with that have policies from when they were kids, and the parents don't really know anything about it, and the kids don't really know anything about it, and there might be 10 grand of cash value in there. Nobody knew anything until they read the book. They were sold life insurance by a great agent that understood that the kids need to have coverage if something happens to them. But nobody was told that they could use cash value. So there is another subject. We do not want to pass before our children. It is a parent's worst nightmare, but it happens. And so you have the choice. Are you going to insure the child, create some cash value for them, create a bank for them, teach them how to use the bank, and should something happen, you have some death benefit so that you can continue to maybe you can't continue. You can mourn, right? You have the ability to mourn. You can take some time off. You can do what you need to do. Some people it takes them a month. Some people it takes them a week. Some people it takes them a year to get back to work. You're never done mourning that child. It's a lifetime. I have clients and friends that have lost children, and it is a lifetime. So don't think that the death benefit is not important. Unfortunately, it is. But on the banking side of things, we can teach them how to use money. We can teach them how to start businesses. We can teach them, they could buy their first bike. They could buy their first used car. They could buy some, what's the big deal right now? Baseball cards or something. They could buy things at rummage sales and resell them. They could make some YouTube videos. They could go buy whatever these kids are into today. I am not keeping up if you can't tell. I am a big fan of Gary Vaynerchuk, and he is like, I was doing all that cool stuff that kids do. And so kudos to him, and I do know a little bit of something, but that's about it. But you can teach them to do things with it that we were not taught. Teach them how to create the cash flow. Oh, I forgot one thing. I'm going to leave you with this. If you want to buy a policy on your child because you think that is going to create wealth for them, then we have to talk about what we're really trying to accomplish here. Are we trying to create wealth for the child through cash value, or are we trying to create generational wealth where I should have a policy and my death benefit, my discounted dollars of death benefit should go to the next generation income tax free, which would actually create more wealth than buying a policy on a child. So a lot of people want to buy life insurance on a child because they think it's going to create a whole bunch of wealth, when in fact it's going to create some wealth, but it's not going to be at the same rate we would if we were passing down death benefit through generational wealth. Okay, I think I hit them all. I'm sure I missed something. But if you have questions on it, as always, you can email me, maryjo@withoutthebank.com, and I am happy to answer those questions. Thank you very much for listening. I appreciate it. Again, please pass this on if you feel that it is good information. You can get the book Life Without the Bank at withoutthebank.com. Grab that, read it, set up your appointment. It's free. And then we'll figure out where to go from there. So let me know if you need anything. Otherwise, thank you. Have a great day, and we'll talk to you in the next podcast.